Okay, so this is exercise 13-17, page 647. Cash flow statement for the Olson Jones Industries. So as we look through the information given to us, we're going to have to calculate a lot of these. So here is the first step. We're going to look at item E, which tells us that there is a $62 credit to retained earnings for net income. Therefore, that is your net income amount that you're going to start with your statement of cash flow. Then you're going to go through the rest of the adjustments. Depreciation, they give us, if you look at your balance sheet, current year versus prior year, you should be able to pick up and calculate the $68 that we have in accumulated depreciation for our current year, less the $42 that we have for prior year. So that's a $26 entry that we made to record depreciation expense. It's a non-cash expense. It was recorded as an expense on our income statement, so we want to add that back. Okay, so the gain on land sale. This is item A. If you look at item A, it says land was sold for $120. Well, here it is. We have cash from sale of land, so that is item A. So we want to decide how are we going to calculate the gain on that. So for us, the investment that we need to report in our investing activities is the $120 for the transaction A. But we're going to go back up here to decide what is our gain. So if we look at our gain, we can see that we had $120, which includes our gain, so that's in our investing activities. But we want to look at our balance sheet, which the net change for the current year for our equipment, for our land, was $250 for current year, and it was $330 for the prior year. So that's a difference of $80. So we're going to take the $120 that we got in proceeds, less the $80 that we had on our balance sheet, and the change in our balance sheet. So that results in a $40 gain. So that's a decrease or an adjustment that we're going to deduct from net income. Because on our income statement for the accrual basis of accounting, that would have added to our net income, right? That would have been an addition to it. Here from as far as the balance sheet goes, you'll need to decide and calculate your current year versus prior year and decide whether it's a current asset and or a current liability. So here, accounts receivable, inventory are both current assets. If they increase, we're going to deduct. And then accounts payable is a liability, so it increased, so we're just going to add. So for this company, Jolson or Olson Jones Industry, we have $38 net cash flow from operations. So if we finish the rest of the cash flow statement based on the information that we have information in item B that tells us that we paid cash for purchase of equipment. So if we look at our equipment account, we have, for our prior year, we have $175. For current year, we have $205. So that is an increase of $30. So if you look at that information, you should be able to say that we purchased equipment, and so we paid. We're in the investing section of it, so we paid for a purchase of equipment. So since it is a receipt of cash for land, we added it, and since it's a payment of cash, we're going to deduct it. So given that information, we have all of the information that is reported for the investing activities for Olson Jones Industry. So let's continue to the financing area, and I have some information over here to the side, which I will show you in a minute. The screenshot is just trying to identify what paid in capital is or paid in excess of common stock. So we're going to get to that in just a minute. If we look at item D, it wants us to determine in our financing area what we're going to report. So D, it says that common stock was issued for cash. So here we need to look at the change in common stock on our balance sheet and paid in capital. So over here, if you can see it, I want to show you, and just let me pull this in just a minute. If you look at paid in capital in excess of par value, this means the amount that an investor paid for my stock in excess of the par value. And then the par value, if you're not already familiar with it, par value is the legal capital per share that we've decided whenever we started our business what our shares of stock was the legal value per share was going to be. So that's the information that I wanted to share with you on this. So going back to our paid-in capital, we're going to have to take the amount that we have in paid-in common stock, which is a difference if you look at current year versus prior year. It is $125 for current year and $80 for prior year, so that's $45. And then if we look at paid-in capital in excess of par common stock, it was current year $85, prior year $70, so that's $15. So that's where we're getting our cash received from sale of common stock. It's an addition because it has cash received. So the next line is, what are we going to do for dividends? And again, we're going to look at dividends, and we're going to see item F. It tells us there is a $24 debit to retained earnings for cash dividends declared. So yes, we declared $24. However, we do, if you look on the balance sheet, we do have a dividend payable on the balance sheet in the amount of $5. So that is a difference of the $19, and it's a payment for cash. 24 minus 5 is a payment of cash of $19. That's what's recorded in your financing activities. So if we pull a total for our financing activities, that's going to be a difference of $41, which is positive. Investing is positive, operating is positive, so we're going to say increase in net cash, which we're just going to take the total of those three sections. We're going to have increase in cash of $169. So now here's the sticking point. You decide and go back to your balance sheet, and you hope that you're in balance because your beginning cash was $14 if you look at your balance sheet, and then at the end of the year your ending cash is $83. So 69 plus 14 is 83. You're in balance. Yay, do a happy dance. Hopefully, if you have any questions on that, we can go through these again in class. Part B of this problem wants to know, it asks why or was Olson Jones net cash flow from operations more or less than net income? Well, we want net income versus net operating activities. Our net income was 62, our operating activities was 36. So if you look at these entries up here, you can see that you had the $26 for depreciation, which is non-cash. Then you had to have the effect of your net gain from your $120 land sale, which is reported in investing. So these are all reconciling items to show that $62 was net income was greater than the amount of the $38, but this is because we're trying to convert from accrual to cash basis. So if I scroll back down here for just a moment, that's what it is. The $26 depreciation expense had no effect on cash. The $120 included $40 gain. It was reported in investing activities. This is converting everything back to cash. AR, there was an increase in AR and inventories, which deducted $24 from operating expenses. And then an increase in AP, so let me fix that. AP was a $14 addition to operating expenses. So hopefully that makes sense to you. You can always have lots of practice. Cengage has lots of embedded resources to continue to help us be able to feel comfortable with the statement of cash flow. Thank you.